Well, holy smokes, what a day in the shipping world today. Charles here from Marhelm for a quick shipping update on May 8th. And what a day it's been so far here at 1:25 Eastern Time. The story of the day is Ardmore, which has gone absolutely parabolic. It's been maybe years since we've seen a tanker company react like this to earnings. This shot from a few moments ago, up about 16% today. They announced earnings this morning, 92 cents per share. And then with their relatively conservative dividend payment, 1/3, they announced a dividend of 31 cents. So I'd be curious to see what's really, driving the share price up. The short interest was not particularly large, just a couple percentage points. They did come out with quite healthy numbers, 40,500 with 60% of the days for the second quarter. And then on the chemical tankers, which have been lagging a little bit, up over 32,000 to 32,500. But, a huge move in the share price. And so, we'll see how that develops now that kind of skyrockets Ardmore up to one of the best valued product tanker companies. INSW was also out today with earnings. They're up, I think, about 7%. $2.92 a share. They announced $1.75 per share of dividend. The big news here being they're down to 14% LTV. So they've really been paying down debt. They did announce two additional new build orders, exercising one of the options there. And then they had, pretty solid numbers as well. Their MR fleet is much older than Ardmore's, but they were out with 38,100 with half the quarter fixed. And then their LR1 pool, the little mousetrap in South America, 65,500, which is, absolutely great numbers, very much above market. So, they had other positive, you can see here in the slide, other positive, moves in some of their other sectors as well. But, they put in a few new build orders the other year. Some of those are coming. Pretty well-timed fleet renewal. Clearly, their LR1 and their MR fleet is a little bit older. And so, with their leverage being this low, potentially they'll kind of re-lever a little bit as those ships deliver. So yeah, you see the positive share price. This was 5 minutes ago, up almost 7.5%, 52-week high from Ardmore. 2020 Bulkers was also out with their earnings in Oslo, $1.25 a share, and announced 30,000 a day gross on the Capes. They had come out and sold two vessels earlier this year, which kind of caught some folks off guard, but they had really, Cape asset prices had gone a bit parabolic. So we'll see, how that drives through to the strategy of 2020, whether that was just harvesting the potential to sell some assets, or if that's going to be a continued theme. 2020 is one of the guys that pay out monthly dividends and pay out all the shares. So, with Capes kind of moving up substantially over the last week, firmly in the mid-30s now, they generate very healthy yields on their fleet at those levels. We had NORAM was out with a commercial update as well. They, there had been a little confusion with them earlier in the year. We had Marty, the CEO, on Marhelm, which was great for an update. At that time, he was optimistic that they would get the rig back to work, and they have done that. So, they had, and this is also another company that pays out monthly dividends. but they're doing 25,700 on the rigs that were working. And they have another rig going back to work in the middle of June. So they had 9 out of 11 rigs working. The 10th is going back, and they're optimistic they might have full utilization maybe later this summer. But, one to watch there. It's a little bit tough to buy given it trades on the Oslo exchange, but with a high spec land drilling fleet and the capital return, given it is one of the Fredrickson companies, always a good one to keep an eye on. Wilhelmsen, Huawei was out with earnings in the car carrier sector. The news here, or the takeaway, I should say, rather, is just that car company management teams remain bullish on 2024, and the longer disruptions in the Red Sea continue, things look quite healthy in 2025. Obviously, rates in the car carrier space have really skyrocketed. Now these guys are recontracting at very healthy rates and spitting off a lot of free cash flow. Stainless Steel, another Oslo listed name that's a little bit off the radar, had their earnings today. As the name entails, they are stainless steel chemical tankers. Those rates have not been quite as strong as the MR market, but 20,600. That market is a bit more of an industrial style, less volatile, more steady as you go. But they're paying out dividends as well. They estimate that'll be about a 20% annualized yield on invested equity. So if you're, it's definitely a sector that's a little bit off the mainstream, but one to check out. We also had Flex LNG out with an update today. They got a new charter for the Constellation, which was the vessel, I believe, that Trafigura had redelivered unexpectedly. So that's 312 days with an option for an additional year. They didn't release the value. Clearly, I think, LNG shipping rates time charter market has been a little bit softer, but it's good to see that they'll, have that vessel back at work. And then we have I don't know if you checked out our recent interview with Matt Warder, but we have a little clip of Matt talking about BTU here.
I mean, let's go ahead and talk about the elephant in the room for Peabody, which is their domestic thermal business in the U.S. They don't really export much at all, so they're not exposed to API2 prices. This is really a domestic consumption issue, and in Q1 24, their production at North Antelope Rochelle was down a lot, and we saw Black Thunder down a lot as well, and I think that's telling us that the PRB, the Powder River Basin, where those mines are, these big, huge operations with very, very low cost, but also these razor thin margins. PRB coal is in trouble at these low gas prices. So, once we get the LNG facilities up and running, maybe they'll fare a little bit better. But, I think it's going to be very tough sledding for the PRB, especially the next 2 years. They have 6 mines in the Illinois Basin, 4 or 5 mines in the Illinois Basin and a couple in the western bituminous regions. Those thermal coal prices are going to be low for the next 2 years. They're kind of back in right now. I think they're back in kind of traditional pricing territory, whereas they were, triple digits a couple of years ago, and just absolutely uncharted territory back then. They've fallen back down to earth, and I think they have more room to go. So I would venture to say that we're going to see, consumers push back tons into 2025, which will lower production, which is going to raise costs. It's not a great business, this year, next year for the time being. So all that said, their seaborne thermal business isn't so bad. It's pretty good. They have a mixture of 5,500 coals, kind of the lower quality Newcastle coals at Wilpinjong, and then they have some kind of Newcastle grade thermal coal as well. I'll go ahead and share screen and we can talk about prices a little bit. We talked about them a bit before, but I'll go ahead and pull that up. And let's pull up Newcastle prices. All right. So, Newcastle prices hit a bottom here back in January, and it moved up, pretty reasonably over the spring, and we're kind of hanging out at this 140 level. I think this is probably the range, 120 to 140, 150. I'll be surprised if we get much over 150 here in the summertime. I certainly think it'll be challenging to get up to 165, but this is sort of what to expect. I think 120 is the cost, 115 is the cost for 140, 150, probably the top end. But they're making okay margins at this level. Let me see where I had them at on a gross profit basis in Q1. Below met coal, by a few $1 million, but you can ostensibly think of BTU at this point as being 50-50 met thermal, in terms of overall EBITDA. I have that changing as Centurion comes on, going from, call it $92 million, $100 million a quarter up to, 250, 260. And then if met coal prices bottom out at cost, the global 90th percentile cost is going to be more like 188 million, but it's going to dwarf thermal coal once Centurion comes on. And so, from this perspective, I think their thermal business is pretty steady. Where they're going to make most of their money is on the met coal side. They have, a couple of mines that have pretty good quality, but mostly they sell a combination of PCI and semi-soft coal, which gets discounts off of this $250 pricing, pretty significant discounts, actually. Typically, like I would assign about a 20% discount to BTU. I think that's probably more like 30, 35%, 40% for the lower quality coals. But Centurion, which is due to come on, have development tons here relatively soon, it's going to fetch this price at or above. So Centurion really is a game changer for them from a revenue and an EBITDA perspective.
We haven't checked out the full interview. Give it a look. Matt has a lot of deep insights into the coal sector. Coal market has kind of traded off to start the year coming into shoulder season. So potentially some good opportunities there. Otherwise, in shipping, Torm was also out today with very healthy numbers. They released for the second quarter to date, 40,500 or so on MRs and about 51,000 on LR2s. They've clearly, been one of the best performing and best return of capital names. And then tomorrow is a day a lot of people will be looking forward to with Scorpio Tankers earnings. So, busy day in the tanker and shipping earnings season this week, and look forward to updating you guys tomorrow.